got that G, got my nullos. I'm just saying. We pull up to the scene, they be filled with jealousy. If a bitch get
stop
finicky, she gon' bring the energy. I hit a phone with a
3, 2, 1, action.
Dear light.
I got chills, then multiply.
So, hello everyone, it's Harvey and I'm back for another video and I hope you guys are having a good time. Welcome back to my channel. How are you guys doing, guys? Option trading, that's the title of this video. And I'm happy because this is something educational on how to make money because, whoo, guys, the world we live in, you need money to survive. So if I can show you guys another way to make, passive income. You guys know I always talk about passive income, and the world today has been so crazy that we need that. Okay, so I'll be talking about option trading. Before going into option trading, you have to get registered with a brokerage account or have a broker's account or one of these brokers like Webull, Robinhood, be a retail investor. In order to do that, you cannot just go on the street and boom, do option trading. You have to be in the stock market. You have to be registered with a brokerage account. Okay,
I'm back, I'm better.
So what is options? Okay, an option is a contract between a buyer and a seller, and it gives the buyer, the owner of the option, it gives them the opportunity to buy or sell underlying assets, also known as stocks, buy underlying assets at a specific strike price and expiration date. It has a specified time and date, okay, in order to be exercised or goes worthless or the above. Okay, so options can provide investors with more opportunities than the traditional buying and selling strategies. Of what they are meaning is that it gives an investor the opportunity to trade and sell stocks as one other option of making an income or a revenue. Option trading is another form. Rather than just buying a stock, waiting for it to appreciate, then you sell the stock, or buying a stock, if it falls, then you sell it at a loss and move on. No, you can actually do option trading to offset those losses or decline in your stock and wait until it appreciates and sell out if you no longer want that stock. Or you can do option trading as another form of revenue and income. It's like putting your stock at a specific strike price and saying, okay, if it gets to this price, I'm willing to sell off, but if it doesn't, I can make premium income from this stock that I have been holding for a long time. Okay, now when they say long means you've had the stock for a while, like 1 year is long in the stock market.
Oh snap, she used the A word. Somebody's about to die. Let's go the other way, y'all.
Wait.
Okay, in the stock market, up to 1 year, you have what we call long capital gain tax. Okay, and then if you've held it below 1 year, it's short capital gain tax. That's for a different video. So what are the advantages and risks of options? Options are cost efficient with great leveraging power. An investor can obtain an option position similar to a stock position without actually trading the stocks themselves. Okay, that's why we have naked calls and covered calls. Okay, like I've explained in the other video, a naked call is when you don't have the stock but you can trade the stock with the intention of possibly owning it, or but you not owning it, but you can still trade the stock. That is another why option is very good, because you don't even have to own the stock to be able to trade, but the person selling has to have that stock, okay, before you trade. Else you still have to you have to have the stock or have buying power, okay, or cash. Okay, so this without actually trading the stocks themselves, but with much more volatility risk. You see what I'm saying? Because if you don't have the stock, then you trade it in options and then it's meant to be exercised and you don't have the stock, bitch, you can lose a lot of money. That's why it's good to do covered calls and puts. That way you have this stock and you can only lose that amount of stock rather than selling options, like 100 options and you don't have it, and then if it doesn't go through or it's fucked up, bitch, where would you have to pay for all that stock you don't have?
Kareem and I are just in a book club of 2.
That's cat, La Cienega.
Honey, we don't want that, so that's why it's risky. Another option of risk is that options are a popular way to hedge your position, okay? That's a good thing. However, when not properly understood by investors, they may pose a high risk of loss. That's what I'm saying. You may say, okay, 10 contracts, which is times 100 shares of a stock. And you're like, oh, I'm selling 10 contracts of this stock. Then let's say it was in the money and now you've sold the, you've bought the rights to buy, like, okay, at this strike price, I'll buy the stock from this person. And then it gets there and you don't have the stock, bitch. Woo! You have to use your money that you don't have to buy all that shares from that person, because it has to be exercised, because you guys have made an agreement. So you have to be careful. That's why it's very, very risky. I prefer doing covered calls and puts because that way I know I have the stock. The worst I can lose is that stock. I can't lose any other money that I don't have, just that stock, okay? The third is that options have the potential to deliver higher percentage of returns and losses. Now, when you do puts, you can buy what we call buying puts. In that aspect, yes, you can make a lot of money. Yes, you can. Or calls. You can sell calls. You can buy puts, you can make a lot of money, because when you do puts, sometimes it's like, okay, the lower the stock goes down, the more money you make as the person who bought the puts, and the less money the person who sold the puts makes, okay? So there is the potential to make lots of money and lots of losses too.
Wait a minute, who am I? That's a Raven moment.
And the fourth would be options provide a strategic alternative to investing in equity. That means if I don't want the stock right now, I can say, okay, I'm buying the rights to buy this stock at this particular price at so day or so time. So I will put like a down payment, okay? Now, if the strike price gets there, I can now buy the stocks at that time. But if it doesn't get there, I would lose that money that I put down. And the person who sold that contract will take that money. See there? So then if it goes through, then I hold on to the stock. If I want to keep it, I'll keep it. If I don't want to keep it, I can sell it off. That's why they said that it is another form of strategy to hold a position, like hold this down for me, let me go get money, then I'll come get it, okay? That's what it means, okay? There are many ways to use options to recreate synthetic positions. See, that's what I'm saying. It's like, hold this for me, let me go get this, okay? By this time I will get it at this price, if it gets to that price. But if it doesn't, I've lost that money that I put as a premium that I paid that person, okay? Now, however, there are many risks associated with trading options, and we suggest to do a lot of research before trading options. Honey, I did a week, because when it comes to option trading, there are two main factors you should know: puts and calls. When you do stocks, you just know shares, fractional shares, blah blah blah. Now, when it comes to option trading, we now have puts and calls, okay? When it comes to puts, you can sell puts or buy puts. when it comes to calls, you can sell calls or buy calls. Now underneath those, you now have what we call naked puts and naked calls. So naked puts and covered puts, naked calls and covered calls. Okay. Okay, you see. So now the difference between naked and covered is that with covered you already have the shares, 100 shares of that stock with covered, but with naked you don't have it. Same for calls. Okay, so that's the difference. Naked is also known as uncovered. Covered is when you have the shares there already, but naked is also known as uncovered. You don't have them, so be careful. That's why you can lose a lot and you can also gain a lot. That's the terminologies. Does that help, sir? So when it comes to puts, you're saying I am putting down the phone because I don't believe this stock will go up, it will just keep going down. So I'm, you know, buying a put. Like I'm betting like, okay, if this stock comes down to this price, I will buy it from the owner of this stock. Okay, when it comes to call, what I'm saying is if this stock goes to this certain point, I would buy it from them. So I would pay a premium. I'll have a debit in my account paying a premium to that person, and they will hold that. So if it ever gets to that price, I'm buying the stock from them, and the rest, the future growth of that stock comes to me and the profits. But if it doesn't get to that price, they'll keep the premium and I will lose that money. So puts is the opposite of calls. I'm putting down the phone because I don't want to deal with this person, or this person is a hater. I don't want to pick up that call, so I'm putting down the phone. Calls, I'm picking up the phone because I'm bullish that the stock will go up. Put is like I'm thinking the stock will go down, so I'm bearish on it, but I'm trying to offset my losses so my losses are not too much. See that? You pick up the phone, you know, you pick up the phone call and you put down the phone. That's the difference between them. Okay, when the market is going up, you go for calls. When the market is coming down, you go for puts. Okay, you're betting that the market will go down even more. So when you buy a put, you're saying that if this market keep going down, I'll be making a profit. But the person who sold the puts to you will be losing money. So what the person who sold the puts to you wants is for it to be out of the money. They want it to be out of the money, but you who bought the put want it to be at the money or in the money. Okay, when it comes to call, the person who bought the call wants it to be, you know, at the money or out the money, but the person who sold it wants it to be in the money. So that way, because if it gets to $10, they may not really want to sell this stock, but they're like, let me just be making some income until, you know, in the meantime. That's why they sell the calls. So most times that's why, you know, so they can have another form of income while waiting on the stock to grow or reduce the, you know, returns that they've lost. Like the stock has gone down and they're like, okay, I don't think this stock, so they are really bearish because like, I don't think this stock will go up to $10, but if it does, then I'll just sell and move on. I don't see any more progress from this stock. So you who buy you're like, oh my god, I believe that this stock will go even further. So if it gets to $10 within this stipulated time, I will buy the stocks from you and I'll take it and sell it to someone else at a higher price or hold on to it for myself. So does that help? So you who wants to buy it, you want it to be at the money or out of the money for the calls. The person who is selling wants it to be possibly at the money so they can move on, but if they don't want that, they just want to keep the premium, then they want it in the money. But when it comes to put, you want it, you who are buying, you want it to go down into, you know, out of the money. No, in the money. You want it to come in so that way you can, you know, below that strike price, you want it into the money so you can keep, you know, those becomes yours now. Okay, but the person who is selling it wants it to be out the money so that way they can keep their stock and their premium. Okay, does that help? I love the basics of this. So yes, option trading, you would hear puts and calls. Stocks, you will hear fractional shares, bears and bulls. Okay, I cannot wait to see you guys soon in the next video. I hope I broke this down very well for you guys. Until next time, see you in it. Yeah, I can't wait to start showing you examples, life examples, like real life when I'm trading, so you can actually see it in person too. Okay, but until next time, from Saturday and DAWSON Studios, I love this.
'Cause I'm loving myself real good. Did you guys hear that? I'm scared. In a way that you never could.